Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative here with the last week in Mortgage Today, our weekly walkthrough, all the latest. all the latest. You totally screwed up my intro there. I had, for the record, 2:02 in the office pool on what time you'd log on. So I win the bet. But on cue, the EVP National Production, Verity Mortgage, and my buddy, Steve Barton. Steve, good to see you, man.
What's up, everybody? How's life?
Doing good. And was just kind of getting going. This is the last week of Mortgage Today, our weekly walk through all the latest happenings in the mortgage industry. And each week, happy to be joined by one of our members as my co-host and a familiar face to the network, host of many sessions virtually and in person over the years. So Steve, good to see you, man. And excited to get caught up here.
Yeah.
So how's things? You didn't have to get all dressed up.
Yeah, well, no, I actually wore a t-shirt with a logo on it. Anytime you put an animal logo, you are officially dressed for business on your clothes. So you're good. But I'm still not wearing any shorts. Never doing that.
I would hope not.
No, it's going good. Life's crazy as always. And, just try to keep grinding with all the different stuff that's coming at us.
It's been so much change since presidential administrations changed, and kind of got to start with the latest news that really just broke a few hours ago. Was that Biden administration formally nominated Alana Mrtgage to be president of Ginnie Mae. She's been working as a senior advisor at HUD. She actually spoke at the TMC, the 12 days of TMC event that we did last December. At that time, she was working for the Housing Finance Policy Center for the Urban Institute. And really her thing is data analytics, using data and analytics to analyze housing trends, disparities. I don't know, any reaction to the news? You have any idea who Alana is or any?
Yeah, no, I was on that one, the call in 12 days. And from that call, you can tell she's smart as hell. But the second thing is the data and the analytics she's going to use, and all the agencies, frankly, are going to start using to try to equalize the disparity in the housing markets, will put a lot of pressure on us, and probably good pressure, stuff that we need to recognize that we need to fix and be part of the solution. And so as this happens, you're going to see a lot of these announcements of who they're putting in charge of these organizations push that to the forefront, because it really hasn't been done yet. It's something that was talked about during the election quite a bit, but now you're starting to see the people roll in. When the people roll in, they're going to start going hard at it. And it's a good thing to get that data.
Yeah, it's really a passionate group, from Marcia Fudge to Alana to Sandra Thompson, the interim director of FHFA. She's going to actually be speaking to our members Monday morning at our TMC summer conference at Terranea. It's just putting together kind of the list of questions that we're going to ask Sandra there. But a lot of them, and there's rumors that Mike Calhoun, who works for the Center of Responsible Housing, could be the formal nominee for the FHA, the permanent FHFA director. But as interim director, Sandra Thompson's been really aggressive. First getting rid of the adverse market fee, which all of us applauded. Then talking about stricter goals for the GSEs on just their goals related around low income and minority lending, and putting some other onus on them. So a lot of the questions that we're looking to ask Sandra when we speak to her next week are related to like the balance there, to starting to expand the credit box. Another change was allowing just positive rental payment history to be as a factor. But those two balances, I mean, we saw things kind of went too far the other way in the lead up to 07 and 08. It's going to be fascinating to see how they balance that.
Yeah, I think it's exciting. We've been working closely with Freddie Mac, and we actually just developed our own bond loan here in the state of Texas with Freddie Mac that we're going to be servicing. That kind of helps expand that box to the people that have the low to moderate income, and takes away having to be a first-time home buyer and some of the restrictions that held up some of the access to capital that these people needed. So I think you're going to see that continue to happen. you have to be open-minded about this stuff, and you have to be able to prepare to pivot quickly, just like we're used to, right? COVID hits, you have to pivot quickly. When this stuff starts coming down, and it will happen quickly, you've got to be ready to adjust some of your business practices, and be able to be prepared to capitalize, because there's going to be a lot of stuff that benefits not only the consumer, but the companies that get on board with helping those consumers.
Yeah, and it's good to see with Alana's appointment, that data and analytics is going to be a big part of how they look to achieve those goals. And some of the critics of, like, some of our depository members that are maybe beholden to CRA requirements, or some of our IMB members that are looking ahead, uncertain about fair lending requirements that might be bestowed upon them. Some of the criticisms of CRA and fair lending in general is that it's been done kind of using antiquated policies that were crafted back in the 50s and the 60s, and it hasn't been using all this great data and analytics is now available to people. So it feels like, the new housing leadership in government is not like the good old boy crew. It's going to be a group of people that is going to be pretty forward thinking, and from all indications there may be some changes, to your point, that can challenge lenders and push lenders, but I think it's going to be well telegraphed. And I think they're going to look to get industry input a lot more than the previous administration.
Yeah, and if you'll see, like, the NBA is really behind a lot of these people, and that is not usually the case, where the NBA so quickly comes out and says, hey, this was a good decision. They usually have a wait and see approach, and then, or they're just, hey, we're not for this type of deal. But I think you're going to see a lot of the support for these people to try to have some success, and we'll be there as well, because any changes that loosen the credit box and give people more access to buying houses and can fix some of the inequalities, or a lot of the inequalities we have, we need to be part of that solution.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week joined by the EVP of National Production from Verity Mortgage, Stephen Barton, and the Shooter McGavin guns. Steve, it feels like things are starting to ease up a little bit as it relates to people looking to buy a home. Some of the stats that have come out recently, Redfin put out a report, which was funny. Only 59% of home offers written by agents faced bidding wars in August, but that was the lowest level in over a year. Inventories are starting to creep up a little bit. The percentage of homes that are being sold for over asking is dropping fairly dramatically. It feels like things are starting to ease a little bit. Is that what you're seeing and feeling in the marketplace?
Yeah, for sure. I mean, you got to think, there was just the buyer's fatigue that started to happen in May, where people are like, I'm over this. You saw 20 to 30% of the buyers just say, screw it, right, and walk away. But now you've got the opposite effect happening. You're starting to see more listings coming on board. I still think with the foreclosures possibility pending in front of us is going to loosen it up even more. But certainly, in our markets that we're in, we are seeing a bigger supply. We're actually seeing seller concessions again. I saw like 5 or 6 deals last week where there were seller concessions to try to win deals and get them done, which is a good thing, right? We want to try to create a good market for the buyers, and that overpayment of the houses that have been done. There is a little bit of fear, that will, when the listings do come back full bear, and they're higher than what they've ever been since the pandemic started. Right now, more listings now, but that kind of gives us a little bit of a bubble. But we're hoping, if the economy can stay strong, that it just continues to grow, and we get those 30% of the buyers that left because of fatigue back in here, and then you get the credit box expanded a little bit, and I think we can equalize it.
It's been really a strange year in many ways, but just as it relates to our industry, like first quarter, Jan apps were great. I think all lenders got out of the gates quick. That historically is not the norm in our industry. And, then we got into spring, and rates dropped, refis really picked up, purchases got off to a good start, but then we're a little muted due to the fatigue that you just mentioned. We didn't have a traditional spring buying season. A lot more of the business was refi than lenders thought through the part of the year. Now we go into the fall, and it feels like we got some momentum on the purchase side. So it's almost been like the inverse of the historical norms of the mortgage industry.
Well, and it's I mean, I guess the good new normal is whatever we see that day, right? There is no more trends that I can count on. And when we're looking at reports or what's going to happen, because traditionally August is one of our biggest months, and it wasn't even our biggest month. January was bigger than August, for crying out loud. But for us, the purchase market, staying focused on that has always been our priority. We've been doing TBD underwriting forever. We never stopped even during the pandemic. We found that helped our homeowners because we were able to remove credit contingencies, income contingencies. So it really helped us win more deals. We changed policies where every loan officer called every listing agent on behalf of the customer and the buyer's agent to try to help win deals. And so we're seeing the net benefit of those things right now, which traditionally you would see in July and August. And we'll continue to kind of adapt to that as it comes along. But the other big thing that's going to cause for a big end of the year is just the number of home starts and the builders. With the weather across, especially Texas, Louisiana, some of our areas, it hasn't been kind. We've had a lot of delays. I anticipate huge new construction closings in November and December. Just here in Texas, Louisiana, we're already seeing that build up right now. If you look at our pipeline of approved loans with close dates in November, December, it's the highest it's ever been. So pretty interesting.
Yeah, some of the supply chain issues that had a lot of builders on hold are starting to ease up. There's so much demand out there. You just look on Wall Street, some of the speculation, some of the home builder stocks are starting to bump a little bit in anticipation of really robust activity over the course of the next 9 to 12 months. Then you mentioned just the weather issues, like where southern border of the country been even tougher to get things going, and just so much suppressed demand there. I mean, we've all read the columns about how underbuilt prior to the pandemic America was, just in terms of need for new housing stock. This last year and a half has only accentuated that. So could see just unprecedented levels of new home construction these next couple of years, I'm thinking. No,
I think so. I mean, your whole deal is going to become a land issue, right? I mean, even if you look at Dallas, they're building further and further out, and the new subdivisions are 50 minutes outside of the center, right? And by the next year, we'll think you'll be past an hour. And but they're not going to stop building houses. But I do think you'll start to see with the cost coming down. Obviously, lumber's down 50% now from its high, which is great. And you're seeing material costs come down as there's now inventory, and the other countries are able to help supply that. That my hope is, and I don't think it will happen, is the builders will start to come back in their pricing. But typically when you have a price up event like this, where builders are able to change the price of your house monthly until you close, they don't like to go backwards. They'll just capitalize on the delta. But hopefully the number of consumers will help ease that, because even the new home build prices are through the roof right now. So
moving back to refis, Black Knight came out with the report late last week. 9.1 trillion with the T of tappable equity in America right now. That's just going up to 80% of the value of homes. It's a record high. The average mortgage holder right now has $173,000 in tappable equity. It's up 20 grand from just a quarter earlier, and fewer than 3% of mortgage holders with a current loan to value of over 90. It's going to be interesting as well to see how the home equity loan market, the cash out refinance activity, a lot of these homeowners are locked into 30-year fixed rates in the twos, and how that's all going to play out. Historically, our industry has not had great secondary market outlets for second liens. Banks have done a lot of the home equity lending. Obviously, the agencies have been able to do cash out refis to 80, but something else that's coming down the pike that's going to be interesting to watch for the mortgage industry.
Yeah, we've seen probably our highest level of cash out refinances in the last 30 days. Texas obviously has the strict laws about being able to go over 80%, but across the board, you're seeing it, right? And so that's the good thing. I mean, probably China's happy if we tapped all that equity, right? More debt for us. But yeah, I think you have to be prepared for those things. And the other thing is you got to have the tools to manage it. I'm not trying to plug any companies, but Sales Boomerang helps us with that. We piloted their home equity cash out program, to where if our customers have a 70% LTV, above a 680 FICO, and more than $10,000 in credit card debt, we get an alert. And so we use that alert to immediately come and do a cash out to save them money. But we also manage their total equity inside of there with the 3 AVM model that they have that runs constantly on all of our customers, so that we can make phone calls if we see somebody at 50% equity. Because what you're finding, because of the equity so big, that most of the LTVs are below 70. So you're not getting hit with the traditional Fannie Mae cash out adjustments. So your pricing is the same as almost a normal refinance. So we're quoting those people, like you said, in the high twos. And then at 15 year, you're closing 2.25 on a cash out loan. when your LTV is that low. So it's unheard of. And I think that's where, if you look at these different services that offer the debt watch and those things like that, is you could actually go in and pay off cars, and you can create generational wealth with being able to pay for college now. So we're seeing a lot of programs where we're going and doing emailers to our people where we know the age of their kids, because our system will do that. And you hit them with the mailer saying, use the equity to help pay for your college because it's tax free. So we need to be on top of that right now, because when that does start to slide around with the foreclosures and everything, that equity might get suppressed a little bit. And so now's the right time.
Such a great point. And, something that I think a lot of lenders are not thinking about or talking about, because, we've been saying rates are going higher for years and years, but the inevitability is they will. And the home appreciation we've seen these last couple of years, coupled with the fact that 30-year fixed rates are still very low, it does present a very good opportunity if it's paying for college or paying off higher interest rate debt or making improvements to your home, to take advantage of that now proactively as lenders, and to reach out to those homeowners that could be helped. Because, if rates were to shoot up a full percentage point, it's going to make that dynamic tougher. I'm trying to think of the scenario that plays out is, like, just say fast forward a year from now, and 30-year fixed rates are in the high threes, or 4% even, say. You have an inordinate number of people that have bought homes or own homes with 30-year fixed rates in the twos. It makes a cash out refinance, even if you have the equity, a tougher proposition. And in that scenario, probably more standalone seconds. But as a lender, you mitigate that by being proactive with your book of business.
Well, and that's the big thing. You're right. The cash outs that we'll see 2 years from now will be because someone has to.
Right.
Right. And now we can do it. Like, I have friends that are doing cash outs and they don't even need the money, but because they can borrow the money at 2.25% on a 15-year, they're turning around and giving it to their financial advisor, who's making probably 10% right now, but a normalized return of 6%. Your cash on cash is too good. Even those people are taking advantage of it for just that reason alone. So I hope that they do stay lower, just for, my hope is through at least the first quarter, so we can shelter kind of what the world looks like. And hopefully by then we've got everything under control with new cases, and the world starts to become somewhat normal, although it'll probably never be normal like we liked it ever before. I can tell you this, my airline expense is through the roof right now, because they only serve drinks in first class now on any plane. So it's not making Kate very happy.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by the EVP of National Production for Verity Mortgage, Stephen Barton. Stephen, the general competitive climate right now, mortgage broker, the side of the business, very outspoken, and saw some gains in market share through the tough winter of 18 and 19. We saw a lot of small independent mortgage bankers become brokers during that tough winter and the period of time that followed. What we're seeing now is a reversal of that. A lot of brokers that are very interested in becoming independent mortgage bankers.
Exactly.
Yeah, what you kind of see during that cycle. UWM continues to make headlines for all different kinds of reasons. Their latest is this no appraisal program, which is essentially just, you don't need an AMC, but we're going to be we're going to take away the middleman. We're just going to become the middleman. Just always love getting your thoughts on just the general competitive climate, banks, credit unions, brokers, bankers, any trends that you've seen, just with the general competitive climate these last several months.
So we do some wholesale too, and UWM is great. For me, I love people that push the envelope and innovate, and they've done no shortage of innovation over the last 36 months. And then this decision, why not create this for yourself? It's not anything that violates any of the Fannie or Freddie or Ginnie regulations on how to order appraisals. It just allows a more streamlined process for the brokers. But I still think you're going to find that shift you're seeing back to banker is going to continue to happen, because for the brokers, obviously UWM is a big monster in the room, and everybody else is coming to try to take their chunk. But the control that a banker still has over it, the personality, as this business gets harder and the technology creeps in on us, to being able to personalize the service on the banking side because you have that control, I think is going to become more important. It's always been important to me, but because I want to be able to control my destiny. But in a broker relationship, you just have the power that they give you, which is very little, and whatever their decision stands. And I think in the customer climate we're going to see, that won't work very well because we can help our customers faster. We can pivot very quickly. And the technology, I do find, if you look at UWM's technology, most of the lenders in the Mortgage Collaborative have a technology that's pretty similar, if not is on par. They're doing a couple different things that we're all trying to get to, but we'll go ahead and stay mortgage bankers for a while.
Yeah, it's just, so we've had some brokers that have joined TMC because they're becoming bankers. We've never really had that happen before, but what we've heard some of them say is just that, like, the paramount fundamental advantage to the broker channel is choice and all these different options. That channel, it seems like the big guys keep getting bigger, and it's making it less about that and more, here's our technology, use it for free, but you got to funnel your business to us. So be interesting to see how that all plays out.
For sure.
Also in the news, realtor.com, and kind of jiving with we were just talking about here, citing that between this period right now, essentially for the next 35-40 days, that the most optimal time to buy a home during the course of the year, citing recent data showing increased listing, lower prices, reduced buyer demand, maybe self-serving. It's realtor.com, but it jives with what we talked about at the beginning of the program.
Yeah, I mean, I don't think they're wrong. You're seeing it right now, especially, what I see on the streets in Dallas or some of the local markets we're in. Now is going to be the next best time to buy, because I think December is going to be frenetic. And then I think once you hit next year, I think you'll have rates low, hopefully for the first, couple of quarters. But as those start to creep up, you're going to see a buying wave quickly, because your buying power at every half a point goes down so much, right? So buying a house at $400,000 house, you can afford it at 2.875, but at 3.875, you can't. So I think that's why the rates will stay suppressed a little bit, but I don't think this report's off at all with the best time to buy a house. Because like I said, we're seeing 5 offers I looked at just with seller concessions, and that hasn't happened since when? I don't even remember the last time somebody gave money to get a deal closed, but it's a good feeling. It needs to happen because that'll keep production going up. But people start reading the easing of the housing market crisis of, shortage of properties and things like that. We can start to pull more buyers back into it. And really the millennials are the ones who got the fatigue more than anybody, because, the statistics before COVID was the millennials are going to stay in apartments and live downtown, and they're not going to buy houses. Then COVID hit and it flipped around on us quickly, because then they're like, I'm stuck in an apartment. Screw this. Right. I want to go outside with my dog. But they also the ones who got the fatigue the fastest, right? And it's frustrating if you're a new home buyer and that's your experience of putting 30 offers in. That's not what this should be about. So I'm hopeful that this is accurate. You can see it with the number of listings that are up. You're seeing a change in how, negotiations are going. Agents are getting smarter and doing things the right way with helping their clients. And I'm hopeful it's going to be a good winter, I think.
Stephen, what about, a lot of positive things happening with housing, with the new presidential administration, expansion of the credit box, and Fannie and Freddie not going under government conservatorship, or not going away from government conservatorship, and all the PSPA amendments we thought were coming down the pike, clearly going to be on hold now. One of the things, though, that is also changing is just the CFPB, the regulatory climate, RESPA, marketing services agreements. Like, as a leader, how do you view that going forward? I mean, I know you guys operate in a very conservatively regulatory way, but it's just, that's something that you have to pay a little bit more attention to now going forward, right?
Who told you we were conservative? Kate? Okay, yeah. Well,
yeah, right. She told me not to talk about it. Yeah.
I think, for us, we've never left the MSA game, just because we do it so compliantly. And if they were to audit it, they would probably think we're crazy for doing MSAs, because we lose more money than we probably should each month, because we don't change anything ever. And if you look at that, I think you're going to see more mortgage companies too, to one of your points on your email, forming partnerships with title companies. Yep. In the last 2 or 3 months, we've been approached probably 6 to 7 times by title companies saying, let's form an ABA. I think you're going to see that happen. Insurance companies are starting to do the same thing, as the small guys try to synergize their business a little bit, prop up a couple other revenue streams, but also try to keep the customer from going to one of these people like a Zillow.com that's trying to offer everything to everybody, right? So I think the MSA is a very important thing. It's a big part of our business and will continue to be in 2022. But I think that other side of it too, with joint ventures or ABAs or MSAs with title and insurance, I think you'll see that pop up more as well.
I think the other thing that's different too, when I was still a lender, we had a lot of marketing services agreements with RE/MAX and Keller Williams offices in Ohio. And, from the compliance side of it, we always wanted other lenders in the office as to not, the steering but now all these realty brokerages, they all have in-house mortgage companies, almost all of them. So I think it reduces a little bit of that risk. That risk of, Verity Mortgage is your only option and loans are being steered there. It's tough to make that case as a regulator if the real estate brokerage itself has an in-house mortgage option.
Well, and you got to think not only that, it's the secondary effect of what happened with COVID is none of the realtors are going into the office. So how the hell are we steering anything?
Exactly right.
So when you like, we have a MSA that we're talking to now, and then they want us to pay a certain amount, and I'm just like, I can't justify it because one, the reason why we wanted MSAs before is we were there to answer questions every day because that's what you got to do for 6 to 9 months before you get a loan. And two, the owners of the offices usually traditionally use that mortgage company to help, show, hey, look, they do a great job. And now with the new model that all these places are going to, I think MSAs are going to struggle if they're not, the majority of the business isn't driven by the leadership of that MSA, right? Because it's going to be hard pressed to make those relationships virtually until we can get some sense of normalcy. And who knows, once we get normalcy with everything that's been built in the technology, if realtors even come back in at all anyway. What's the point, right? They can do their meetings virtually all the time. So the MSA landscape is going to be interesting to watch over the next 12 to 18 months. I do find that more people are going with the JV model. We're starting to see that more often, or just creating their own that they do. And for me, I always want that. Because I always know I can beat them. And I know that if they want to form their own mortgage company, it's usually better for us as lenders or brokers. Obviously, you see what happened with RE/MAX and with Keller Williams. We beat them every time. But just to see what happens over the next 12 months to that is going to be very interesting for us.
Lastly, I had Kate on the new show we're doing on Mondays, Monday Mortgage Quarterback, representing the Saints. She's obviously just elated with the great start from them, beating the pants off Aaron Rodgers and the Packers. Your Cowboys.
Is that Aaron Rodgers was playing quarterback? Are you sure?
I thought your Cowboys had the Bucs beat last Thursday night, but
Rich, you're too sweet. That's not what was happening. Listen to me. Anytime you leave the best athlete in the history of sports 1 minute and 22 seconds, you're in trouble. Anytime you leave 1 minute, 22 seconds and you got the Cowboys defense, you're done. But, like you said, you went up against the champs, you stand into the fight until the very end. And so I think there's a lot to be said for the heart. Dak looked great. What a great leader that guy is, coming back and being a great deal. And then the next day, your best receiver gets out 5 games and your right tackle gets a drug suspension. Yeah. So back to the drawing board. They're like a mortgage company. Every time you think you're going to have some success, somebody changes something on you. You got to retool.
Never a dull moment. So, Stephen, always good to see you, bud. Thanks for joining me this week. I appreciate it.
Yeah, no problem. Good to see you, Rich. Good to see everybody. Have a great day.
And to all our attendees, we're here every Tuesday, 2 p.m. Eastern with the Last Week in Mortgage Today. And as always, we'll release this to our YouTube channel and as a podcast where I know a lot of you listen and watch as well. So until next week, have a great rest of the week, everyone. Take care.